I'm going to talk about two ways that you can invest your money for growth. Number one is by investing your money into stocks, and number two is by investing your money into startups. Let's start by talking about stocks because this is the most accessible way to invest your money for growth. There are certain companies in the stock market that are trying to grow as big as possible, as fast as possible, and generally they're a little bit younger and they're just trying to get as much market share as possible. This can be a good investment because if you can get into a big company like Amazon before it's Amazon, well then you can see a lot of upside. But a lot of companies are not going to become Amazon. Some of them will fail. So more risk for more potential return. Again, you can invest into the individual company or you can invest into a fund that's giving you exposure to more of these growth type companies. If you want to invest into the individual company, it comes with more risk for more potential return. But for the purposes of this video, I'm going to talk about funds specifically because those have generally less risk and less work on your part. One way to do this with the least amount of risk is by investing your money into the S&P 500. This is a group of the 500 largest companies in the stock market, and now your goal is to see the stock market grow. More specifically, the 500 largest companies in the stock market grow, and you don't have to go out and individually invest into all 500 of those companies. You can invest into a fund like VOO or SPY. As a disclaimer, I'm personally invested in VOO. Both of these funds, VOO is created by Vanguard, SPY is created by SPDR, pronounced spider, and these two funds are both giving me exposure to the S&P 500. Again, nothing special here. You're just investing your money really into the broad economy, and now if the United States economy grows, the S&P 500 will probably be growing, and it's a way to get exposure to that growth without getting too niche or taking on too much risk. You're kind of just investing in the American economy. If you're okay taking on a little bit more risk, another option you can consider is something like QQQ, which will give you exposure to the NASDAQ. The NASDAQ is a group of the 100 largest companies in the stock market that are not financial, which means many of these companies in the NASDAQ are tech companies. Again, many of these tech companies are working to grow bigger, faster, because that's just kind of how the tech industry works. It's all about innovation and speed and agility. So more risk, more volatility for more potential return. A third option you can consider is something like VUG. This is an ETF created by Vanguard. This is a growth ETF that specializes in large cap companies. So again, for the purposes of this video, I'm not focusing on the higher risk growth stocks. I'm focusing on the lower risk growth stocks. This fund is focusing on the larger companies that are focused on growth. And now instead of you going out and investing in each one of those companies, this fund will give you exposure to those companies that are focused on growth. Again, you can take on more risk. There's a ton of funds out there that will give you exposure to the more startup-y, the smaller companies have the potential for much larger gains, but they also come with much more risk. So you just have to figure out where on the risk tolerance scale that you fit. For the purpose of this video, I'm not going too much into the risk side. I just want you to start thinking like an investor. The other way to invest your money for growth outside of the stock market is to invest your money into startups. Now, I love entrepreneurs. I love working with entrepreneurs, and I have invested my own money into entrepreneurs, and it is extremely risky because most startups will fail. But if you can invest your money into a startup that does grow and maybe it gets acquired by a larger company or maybe it goes public, well, now you can see the value of your investment grow by a lot. And that will hopefully make up for all of your losses. This is what Shark Tank is all about. If you've ever seen the show Shark Tank, the sharks are trying to invest in startup companies, and then they're hoping that that company will get acquired or that the company will go public. That's what it is to invest in startups. Now, back in the day, investing in startups was very difficult because you had to find the individual company and broker a deal. Nowadays, it's much simpler because there's a lot of platforms on the internet. For example, you can look at WeFunder. For example, you can look at Start Engine. For example, you can look at Republic. I'm not sponsored by any of these three companies. I'm just telling you what they are. These three companies are now in the business of helping regular investors invest into startups. Again, a lot more risk for a lot of potential return. Most of these startups will fail. Most of these companies will be a black hole for your money, but if you can invest your money into a startup that ends up growing big, well, that could be a big potential investment opportunity. But again, are you going to do that? Well, most of the times you're going to fail. But for people that have that extra money that they're interested in investing into startups, this could be an opportunity now because it's a lot easier to invest in startups than it was before. Now let's talk about investment opportunity number 3, which is investing your money to protect you against a recession, inflation, and a depression. Let's think about worst case scenarios. What about if we have a lot of inflation? What happens if we see a recession? What happens if we see a depression? how do you protect yourself? How do you protect your family? How do you protect your income? And how do you protect your wealth from that? And this is where investment opportunity number 3 for protection comes into play. Now, I'm going to talk about 3 different ways that you can do this. Number 1 is by investing your money into physical gold. Number 2 is by looking at something like Bitcoin. And number 3 is by investing your money into foreign economies. So let's break this down one by one, starting with physical gold. So I've been investing in gold for a number of years now, and the reason why I started investing in gold isn't because of what happened during the pandemic. It's actually because in the traditional Indian culture, inflation is kind of baked into the economy. A lot of people in India may not know what inflation is, but they understand the concept because inflation has been around for a long time. And so what a lot of people will do who are not extremely wealthy is when they get extra cash, these rupees, they will convert these rupees into physical gold, because in India, gold is like real money, it's wealth. And it feels like over the last few years, a lot of people around the world have been catching on to this gold trend because gold prices have been booming. Why have they been booming? Because investors have been concerned about inflation. They're worried about the value of the dollar dropping. Investors are concerned about the economy. They've been worried about recessions. They've been worried about tariffs. And so all these things have had investors starting to look for alternatives as a way to save their hard-earned money. And we know that inflation has been happening over the last 5 years. It's been happening over the last 50 years, and it's probably not going away. So if I think in theory, if I have $10,000 of cash and $10,000 of physical gold, and I take both of these two things and I bury them in my backyard and I don't touch them for 10 years, my theory is that in 10 years, the physical gold is going to have more buying power than the cash. Why? Because if inflation happens, the value of the dollar goes down, and generally, not always, but generally, that inflation benefits the prices of physical gold. But I don't like to think of gold as an investment, because when you buy gold, it just sits there and it looks back at you. It doesn't actually produce anything of value. When I invest in a rental property, the rental property is producing value because somebody can live there and use that property. If I invest in Amazon, that Amazon stock is actually producing value because Amazon is working to sell a product. They're working to improve their profits. There's an actual value there. That gold, sure, it could be used in dentistry and jewelry, but it's not doing anything. It's just sitting there in a vault. It's sitting there in a drawer. It's not doing anything. That's why I like to think of gold as a physical form of money, a physical form of saving money, and it can be a form of protection. Again, just like anything else, investing is risky. Investing in gold is risky. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube, because I'm not a financial advisor. I'm just talking from my own education and experience here. But gold can be an option. Some people like to talk about silver and other metals. I don't like talking about them only because I don't invest in those things. I invest in physical gold, so I talk about that. There's a lot of ways to get exposure to gold. I like the idea of actually investing in the physical gold because that's the actual product. You can get exposure to gold by investing in gold ETFs. You can invest in gold mining stocks, but I like the physical asset. Then we come to number 2, Bitcoin. Now, Bitcoin is a lot more speculative, and we don't know what's going to happen with Bitcoin. Bitcoin prices go up, they go down. They've crashed, they've boomed. It hasn't proven the test of time. However, we've known that Bitcoin prices are a lot higher today than they were a few years ago, and maybe they'll continue to go up, maybe they won't. But the idea behind Bitcoin is that it is a decentralized, worldwide currency. Now, a lot of people don't use it as a currency. However, it's supposed to be a store of wealth outside of your own fiat currency. Now, full disclaimer, I started buying Bitcoin back when it was around $3,000 a coin. Yes, I sold some when it was around $70-some thousand a coin. I still own Bitcoin today, but for me, I look at it as a very speculative investment. To me, I understand that Bitcoin prices can go up and they can go down extremely fast, so I don't look at it as something that is a core piece of my portfolio. It is part of the speculative part of my portfolio, because if it was to go down to zero, it wouldn't affect me at all. That's the way I like to think about it, because to me, it is very speculative, and that's the way I price it in my portfolio. And the number 3 are investing into foreign countries and foreign economies, because if the United States were to go into a recession or even a depression, well, that doesn't necessarily mean that every country is going to end up in a recession or a depression. Now, yes, the United States economy is the world's largest economy, and if the United States economy goes down, it will impact many, if not all, countries around the world, but some countries will be impacted less more than others. And this is where you can have some diversification, some real diversification, by investing in companies or investing in countries that are not the United States. Let me give you a few examples of ETFs that give investors exposure to these foreign countries. Again, I can't tell you what to invest in. This is just to help your research. Number 1 is IEMG. This is an ETF that gives the exposure to large, middle, and small cap companies in emerging market economies. So essentially, this is investing in emerging markets, those smaller economies that are trying to become more developed, and it's investing in the small, middle, and large cap companies, all size companies there. So one way to start. Number 2 is VWO, and as a disclaimer, I'm personally invested in VWO. This is an ETF created by Vanguard, which is also giving exposure to foreign countries and foreign economies. More specifically, this is investing in broad stocks in countries like China, Brazil, Taiwan, and South Africa. And then we have EEM, again, another ETF, which is giving you exposure to large and mid-cap emerging market equities. Essentially, this means it's investing the larger companies and the middle-sized companies in these growing economies around the world. Again, more risk for more potential return. More risk because it's not a country that's the United States. It's not backed by the United States economy. It's not backed by the United States government. It's not backed by the United States military. But if these countries are growing while the company is growing, that has the potential for bigger returns in the long term. Guaranteed? No, absolutely not. In fact, this is more risky than others, but it can create potential opportunities, and it's a way to protect you against downturns in the United States. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.